Every quarter, thousands of companies stand in front of the world and tell investors exactly how much money they made. Wall Street cheers, stock prices jump, headlines call it a beat. But here's the uncomfortable truth almost nobody talks about. A huge percentage of those earnings numbers are not real profits at all. They are carefully engineered illusions, built inside legal loopholes, and investors have been trained to applaud them without asking a single question. In 2026, this isn't a fringe theory. It's happening in plain sight inside the biggest companies on the planet, and most people watching their portfolios grow have no idea they're standing on top of it. Let's start with a number that should stop you in your tracks. Depending on the year, somewhere between 15 and 25% of S&P 500 companies report what's called adjusted earnings that are significantly higher than their actual audited GAAP earnings. GAAP stands for Generally Accepted Accounting Principles. It's the strict, standardized rulebook that's supposed to keep everyone honest. But companies have found a way around it. They report their official GAAP numbers, and then, right next to them, they report their own custom version of profit. They call it adjusted earnings, or non-GAAP earnings, or my personal favorite, core earnings. And in that adjustment, all sorts of inconvenient expenses quietly disappear. Here's how it works. Imagine a tech company loses $500 million this year under strict accounting rules. That's the real number. But the company doesn't want that number on the front page. So they say, let's not count stock-based compensation as an expense because, well, it's not cash leaving the bank account. They exclude restructuring costs because those are one-time. They exclude legal settlements because those are unusual. By the time they're done adjusting, that $500 million loss has magically transformed into a $300 million profit. Same company, same year, same business. Two completely different stories, and Wall Street almost always reacts to the second one. This isn't illegal. That's what makes it so dangerous. Non-GAAP reporting is completely legal, and companies are required to show both numbers side by side. But here's the psychological trick. Earnings calls, press releases, and news headlines almost always lead with the adjusted number. Analysts build their price targets around it. Algorithms trade on it within milliseconds of release. The real number, the GAAP number, often gets buried 3 paragraphs deep in a press release that most investors never read past the headline. Now, stock-based compensation deserves its own spotlight because this is where the illusion gets really interesting. Companies love paying employees in stock instead of cash. It feels efficient. It aligns incentives, but it's still a real cost. When a company hands out $1 billion worth of stock to its engineers, that value comes from somewhere. It dilutes existing shareholders. It's real economic cost, just like a cash salary. Yet under adjusted earnings, that cost often gets erased completely, as if it never happened. Some of the biggest names in tech have paid out tens of billions of dollars in stock-based compensation over a decade. And if you added all of that back into their official profit numbers, their earnings would look dramatically smaller. But almost nobody does that math because almost nobody's asking them to. So why does this keep happening year after year without regulators shutting it down? Because incentives on Wall Street are built around beating expectations, not around telling the truth. Analysts set earnings targets based on adjusted numbers. Executive bonuses are frequently tied to hitting those same adjusted numbers. And here's the twist that should really make you pause. The company itself chooses what counts as an adjustment. There's no universal rule book for non-GAAP reporting. Every company gets to invent its own definition of profit, and shockingly, that definition almost always makes the company look better than reality. Let's talk about a real example that shook the investing world. In 2001, Enron was reporting glowing adjusted earnings while hiding billions of dollars in debt through off-balance sheet entities. Investors cheered the headline numbers right up until the company collapsed into one of the largest bankruptcies in American history. That scandal led to new regulations. But 2 decades later, the loopholes evolved instead of disappearing. Today, it's not hidden debt through shell companies. It's stock compensation quietly excluded from expenses, one-time restructuring charges that somehow repeat every single year, and impairment losses waved away as accounting technicalities. Here's something that should genuinely worry long-term investors. Studies tracking S&P 500 companies have found that adjusted earnings, on average, come in noticeably higher than GAAP earnings, sometimes by 10 to 20%, depending on the year and sector. That gap isn't random. It tends to widen right before economic downturns, when companies feel the most pressure to protect their stock price. In other words, the bubble isn't constant. It stretches exactly when the truth would hurt the most. So what happens when the gap finally gets exposed? History gives us a clear pattern. When a company's real financial health can no longer be disguised through creative accounting, the correction is often violent. Stock prices that were built on adjusted earnings can crash far harder than the underlying business decline would suggest, because investors weren't just losing money, they were losing trust. And trust, once broken, takes years to rebuild. We saw fragments of this play out with companies like WeWork, whose pre-IPO documents featured a metric called Community Adjusted EBITDA, a number so creatively adjusted adjusted that even seasoned Wall Street analysts openly mocked it. That company's valuation collapsed from $47 billion to a fraction of that within about a year. Now, here's the part most people get wrong. This isn't a call to panic and assume every company is lying. Plenty of adjustments are genuinely reasonable. A company excluding a truly one-time natural disaster cost from its earnings isn't necessarily deceiving anyone. The problem isn't that adjusted earnings exist. The problem is when investors stop checking the difference between the story and the reality, when one-time charges show up every single year, when stock compensation, one of the largest and most predictable costs at many companies, gets treated as if it doesn't exist. The biggest mistake investors make isn't buying an overvalued stock. It's never learning to read past the headline. It's trusting a number a company invented about itself instead of checking the audited version sitting quietly beside it. The smartest investors in the world, the ones who've compounded wealth for decades, have one habit in common. They always ask what a company doesn't want them to see, and they go find that number on purpose every single time. So the next time a company proudly announces it beat earnings expectations, ask yourself a simple question. Beat which earnings? The real ones or the story?